execution under the current leadership.
Annualized recurring revenue is a milestone. I am not taking a different way, and we need to be extremely
Slowly summarized by the low forward enterprise value to
the CFO turnover,
I agree completely on the tech.
Is this stock overvalued or undervalued? Could this stock gain 100% until the end of the year? Stay until the end of the video and to know the answer.
SentinelOne, trading under the ticker symbol S on the New York Stock Exchange, is currently hovering right near $14.19. That places it at the absolute lower end of its 52-week range, a range that stretches from $12.24 up to $21.40. We are looking at a recent 6% drop, and if you look closely at the trading numbers, the sheer volume we are seeing implies a massive, significant institutional sell-off immediately following their Q4 guidance. We need to take our time and unpack this today, because we are looking at a central dislocation in the 2026 equity landscape. SentinelOne is undeniably a pioneer in autonomous AI-driven endpoint security, yet it currently trades at a multi-year low forward enterprise value to revenue multiple. It is sitting at approximately 3.8 to 4.1 times. Meanwhile, competitors, specifically giants like CrowdStrike, trade at 20.2 to 22.3 times. I look at this landscape, I look at the underlying technology, and frankly, I am arguing that SentinelOne is fundamentally severely undervalued. It represents a rare growth at a reasonable price opportunity in a crowded tech sector, one that is fully capable of a 100% gain due to its definitive pivot to profitability and its highly successful AI monetization.
Well, I come at it from a very different way, and we need to be extremely clear about what those market numbers are actually telling us right now. That roughly 4 times multiple, that is not a dislocation, not at all. It accurately reflects a severe deceleration in top-line growth. It reflects massive scale disadvantages when stacked against those mega-cap rivals you mentioned. And honestly, it reflects ongoing management execution risks that the broader market simply cannot and should not ignore.
Look, let's digest the actual numbers from the third quarter of fiscal 2026 before we write off their execution, because I believe the market is completely mispricing SentinelOne's operational maturation. I want to highlight the specific metrics slowly because they are staggering when you pull them apart. Revenue reached $258.9 million. That is a 23% increase year over year, which successfully beat the analyst consensus.
Right, but beating consensus by a hair doesn't automatically mean the underlying business is accelerating.
True, I will grant you that, but it is the margin profile that tells the real story here. The non-GAAP operating margin hit 7%. Let's just pause on that number for a second. That is a massive 1,200 basis point improvement from the negative 5% reported in the same period just a year prior. A 1,200 basis point swing means they aren't just selling more software, they are fundamentally restructuring how much it costs them to deliver their platform. You do not see efficiency pivots like that very often in this sector.
I will concede that a 1,200 basis point swing is a wild shift when you put it in perspective. It definitely shows they can cut the bloat, but
it is more than just cutting bloat, though, because they are pairing it with future revenue security. We have to look at the remaining performance obligations, or RPO. For anyone tracking the deep financials, RPO is essentially the revenue they have contracted but haven't actually recognized yet. It is the guaranteed money locked into the pipeline. Their RPO grew 35%, reaching $1.3 billion. That specific metric proves a company is actively locking in larger, long-term enterprise commitments. These are not just month-to-month subscriptions that can vanish overnight. When you conclude that they are pairing this $1.3 billion backlog with completely stable 79% gross margins and positive free cash flow, the technological differentiation of their on-device, offline-capable AI absolutely warrants a significant, immediate multiple re-rating.
I'm sorry, but I just don't buy that. Let me tell you why. The underlying deceleration and the macro headwinds are the real story here,
not the rear-view mirror of an admittedly solid Q3. You are focusing on a great quarter, but the market is a forward-looking mechanism. You have to focus on the Q4 fiscal 2026 guidance miss.
I mean, it was a highly conservative guide.
Conservative or not, it was still a miss. Management projected $271 million against an analyst consensus of $273.5 million. Yes, crossing $1.06 billion in annualized recurring revenue is a milestone. I am not taking that away from them. It proves they are a real player. But SentinelOne is competing in an increasingly polarized market against absolute behemoths like CrowdStrike and Microsoft. And we cannot just gloss over why that 6% stock drop actually happened on such massive volume. It was triggered not just by that soft guidance, but by the announcement of the retirement of CFO Barbara Larson. When your chief financial officer steps down right as growth is visibly slowing, that signals management instability during a highly critical transition phase. The market is pricing in that risk and doing so appropriately.
I see why you might think that, but let me give you a different perspective on how that risk is being priced relative to the broader sector. Let's really drill down into this valuation gap. The industry average price-to-sales ratio right now is 12.2 times. We have a street-high target of $30 from Cantor Fitzgerald, which represents a 111.4% upside from current levels.
Analyst targets are notoriously lagging indicators, though. You know that.
Perhaps, but the math behind it is what matters. Even if we assume a highly conservative multiple expansion, let's say the multiple simply expands to 8 times, which, mind you, is still less than half of CrowdStrike's current multiple. If it hits 8, the stock effectively doubles. And we aren't just relying on optimistic sell-side analyst targets here. Simple Wall Street models using discounted future cash flows show the stock is exactly 29.4% undervalued today, based purely on the cash it is projected to generate. You can't argue with the cash flow math.
That is a compelling argument in a vacuum, sure. But have you considered that CrowdStrike's premium is fundamentally justified by its massive scale and its high profitability? CrowdStrike isn't just growing. They are cash-printing machines at this point. SentinelOne is only just now reaching operating profitability. You mentioned the industry average of 12.2 times. Well, look at Palo Alto Networks. Palo Alto is a mature, highly profitable entity with an incredibly sticky ecosystem, and they trade at 12.1 times forward sales.
But Palo Alto isn't growing at the same rate. You are comparing apples and oranges.
No, but they have the stability the market crave right now, which justifies their multiple. SentinelOne is being correctly priced as a smaller point solution. The harsh reality of the 2026 cybersecurity market is that smaller players risk being squeezed out entirely by broader consolidation strategies. Rivals like Palo Alto and Microsoft are offering deep, aggressive platform discounts to take over the entire security stack. If a large enterprise can get 80% of what SentinelOne does for essentially free because it is bundled into an overarching enterprise agreement, that 4 times multiple suddenly makes a lot of sense.
That is an interesting point, though I would frame it very differently. Calling SentinelOne a smaller point solution completely ignores the fundamental shift in their entire architecture over the last year. They are not just a point solution anymore.
How so? The market still largely views them as a specialized endpoint protection tool.
Which is exactly why the market is wrong and where the opportunity lies. Look at the recent launch of the Singularity Identity Platform in February 2026. This wasn't just some minor feature update they pushed out. It was specifically engineered to address both human and machine identity breaches. In the current threat landscape, identity is the #1 breach vector. Add to that the massive, undeniable success of Purple AI. We are talking about a greater than 40% attach rate in Q3 alone.
Let's clarify that attach rate for a moment, because 40% is high, but we need context.
It is incredibly high. A 40% attach rate means that 4 out of 10 customers are looking at this new generative AI security tool and actively choosing to pay more to integrate it. It proves they aren't just selling a base product and hoping for the best. They are successfully upselling their ecosystem. And let's not forget the triple-digit growth in their data solutions following the Observo AI acquisition. That acquisition gave them a real, viable alternative to legacy CM solutions, security information and event management systems, which are notoriously clunky and expensive. They are successfully moving upmarket.
The upmarket metrics are admittedly strong. I'll give you that.
Exactly. Their cohort of customers spending over $100,000 in annualized recurring revenue grew 23%, reaching 1,572 customers. You do not get nearly 1,600 major enterprises to spend over 6 figures a year on a disposable point solution. That is simply not the profile of a company getting squeezed out by Microsoft.
I acknowledge the strong technological foundation. I really do. They routinely excel in MIT evaluations, which are the gold standard for testing threat detection. And that 4.8 out of 5.0 Gartner Peer Insights rating is highly respectable. Enterprise users genuinely love the product. But my core concern is that this technological edge simply isn't translating into hypergrowth anymore.
23% growth isn't exactly stagnation.
But you just noted the upmarket traction, and yet the full-year revenue growth is projected at only 22%. That is a measurable deceleration from their historical norms. You have to question whether AI features, even highly adopted ones with a 40% attach rate like Purple AI, are enough to displace entrenched legacy vendors. Let's use an analogy here to make it clear. Think of Microsoft Defender like the default security system that comes built into your new office building. It is essentially free because it is bundled directly into your Microsoft 365 environments.
Right, but it is just a basic lock on the door. SentinelOne is the specialized laser grid.
Exactly. But for a chief information security officer looking to consolidate spend in a really tough macro environment, a good enough bundled solution from Microsoft often wins the budget meeting. To make the sale, SentinelOne has to prove that the specialized laser grid is an absolute mission-critical necessity across the entire platform. If they can't prove that massive return on investment, the CISO just checks the Microsoft box and moves on. That dynamic is the ceiling on their growth right now.
I'm not convinced by that line of reasoning because SentinelOne's technological differentiation is precisely what makes it mission critical. Specifically, their offline capabilities. Think about it. If a ransomware group severs an enterprise's connection to the cloud, cloud-dependent systems like Microsoft and even CrowdStrike can be severely compromised. SentinelOne's AI models run on-device. They protect the endpoint even when the network cord is literally cut. That is the ultimate insurance policy for any CISO dealing with critical infrastructure.
It is a great feature, undoubtedly, but the decelerating growth suggests it might be a niche requirement rather than a universal one. Most corporate networks are cloud-first now.
Well, let's shift to the governance and operational execution, because you raised the CFO transition earlier as a major red flag. I actually view the CFO transition as a highly positive maturation step. Barbara Larson got them to the billion-dollar ARR mark, which is fantastic. But Sonali Parekh's appointment in March 2026 brings the exact type of rigorous financial governance required to drive long-term margin expansion. It is a completely normal growing pain to bring in a new financial architect for the next phase of global scale.
But the optics of doing it right when growth is slowing down, that is what spooked the institutional investors. You saw the volume of the sell-off.
The market overreacted. It happens. Furthermore, look at their global execution under the current leadership team. International operations are absolutely booming. They are up 34% year over year, and international now makes up 40% of total revenue. That is heavily supported by the new sector agreement, which massively expands their distribution reach across Australia and New Zealand. They are also quietly cleaning up legacy operational hurdles. Just recently, they secured a complete resolution of the Israeli tax authority transfer pricing issues.
Transfer pricing is usually buried deep in the weeds of the 10K filings. I doubt the broader market is trading on that.
It is in the weeds, sure, but it matters deeply to the bottom line. When you operate a massive global R&D hub in Israel, tax ambiguities can create huge liabilities. Resolving that cleans up the balance sheet and removes a lingering shadow of uncertainty. Finally, if you still believe the broader market won't naturally re-rate them based on these improving fundamentals, we have to acknowledge that at this incredibly low valuation, SentinelOne is a prime M&A target. A strategic acquisition from a larger legacy tech player looking to instantly upgrade their AI capabilities could easily yield a 30 to 50% premium. That comfortably pushes the stock into the high 20s, providing a massive floor for the equity right now.
I have to push back strongly on using M&A speculation as a reliable investment thesis.
Betting on a white knight acquisition to bail out a low valuation is a very dangerous game. It assumes a buyer is willing to absorb the integration headaches of a billion-dollar revenue company just for the tech. And if we want to talk about confidence in the company's trajectory and governance, we have to look at the optics of insider selling.
Ah, you are referring to the CEO's stock sales.
Yes, I am. CEO Tomer Weingarten sold 39,472 shares at 52-week lows in February 2026.
We should be clear here, though, that it was executed under a pre-planned 10b5-1 trading plan. He didn't just wake up one morning, see the stock price, and decide to dump shares.
I know what a 10b5-1 plan is, and the institutional market knows it too. But the optics of the founder and CEO's automated plan selling nearly 40,000 shares at the absolute bottom of the market dampens sentiment significantly. It doesn't exactly scream this equity is about to double. Look, I agree with you that the macro tailwind is massive. Cybersecurity is not discretionary spending. A projected $522 billion global security total addressable market by 2026 is very real, and there is certainly room for multiple winners. But SentinelOne currently has a negative return on equity of negative 25.8%.
Which is a backward-looking trailing metric.
But an important one for value investors trying to make sense of this sector. That metric, combined with the execution risks we have discussed, the CFO turnover, the fierce bundling from Microsoft, the decelerating top line, demands a strict show-me approach from the market. Until they prove they can definitively re-accelerate growth against the megacaps, multiple expansions simply cannot be justified.
Let's slowly summarize where the fundamental thesis stands on both sides, because there are a lot of moving parts here for people to digest. From my perspective, SentinelOne has successfully executed a deeply difficult pivot. They are actively moving toward a projected 10% free cash flow margin. They have secured a 35% growth rate in their remaining performance obligations, effectively locking in $1.3 billion of future enterprise revenue. And they have demonstrated undeniable market traction and monetization of their newer AI tools, specifically Purple AI and the Singularity Data Lake. When you carefully weigh those profound operational improvements against a roughly 4 times forward revenue multiple, a multiple that is a fraction of its peers, the only logical conclusion is that this is a temporary, severe market dislocation.
And my counter to that remains grounded in the structural reality of the market today. This valuation is a perfectly rational response to the data. We are looking at a company experiencing undeniable, decelerating top-line growth. 22% growth is fine, but it doesn't command a 20 times multiple. Not anymore. They are facing aggressive, deep discount bundling by mega-cap competitors who have vastly superior distribution networks. And they are navigating executive turnover at the CFO position while insider selling occurs at 52-week lows. The market is pricing in the harsh reality of the 2026 landscape, not a temporary dislocation.
Despite our core disagreement on whether the current valuation multiple is fair, I think we both clearly see the underlying value of the actual tech. SentinelOne's autonomous, offline-capable AI engine and its storyline forensics feature, which visually maps out attack timelines so that non-expert staff can actually understand complex breaches, these provide a very genuine, highly defensible technological moat.
I agree completely on the tech. The on-device autonomous capability, the fact that it protects critical hospital or financial infrastructure even when completely disconnected from the cloud, is a distinct, undeniable advantage over CrowdStrike and Microsoft. Our divide really centers on whether that specific technological advantage provides them with the sheer scale and market power required to command industry valuation norm.
It is incredibly complex to assign a fair value to high-growth technology transitions, especially within a rapidly consolidating market where generative AI is fundamentally changing the architecture of how we defend networks. There is an immense amount of data to unpack in these numbers, from RPO growth to executive transitions. We invite everyone listening to look deeper, review the source financial reports, read through the 10K filings, and examine the varied analyst models to form your own conclusions on where this equity is ultimately headed in 2026.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!